Things are looking up for crude oil, and it's bringing hedge funds back. They haven't been so bullish on Brent crude since March, and they increased their net wagers on rising West Texas Intermediate prices by the most since December. The two benchmarks are now both trading above their 200-a-day moving averages in a sign of strength, with Brent settling above $56/barrel last week, and West Texas Intermediate above $50. The fundamentals are looking a heck of a lot better, Phil Flynn, senior market analyst at Price Futures Group in Chicago, said. We still think this market is a breakout to the upside waiting to happen. Things began looking brighter this month, after the U.S. Energy Information Administration lowered its 2017 production forecast, and the International Energy Agency increased its estimate for global demand growth. At the same time, efforts led by OPEC to trim a global supply glut seem to be working. Excess inventories in developed economies, measured against their 5-year average, have declined by about 74 million barrels, or 28%, since the start of the year, according to the International Energy Agency. Prices have been moving nicely, trending towards technical levels. People are going to be less reluctant to build long positions. The tide has turned particularly for Brent, with futures for near-term delivery increasingly trading at a premium to longer-dated contracts, a pattern known as backwardation that shows demand is exceeding supplies. The global benchmark for November delivery was at $56.77/barrel on Monday, compared with $55.44 for May 2018 settlement. Brent is also trading at its widest premium to West Texas Intermediate in 2 years. That's partly because U.S. crude stockpiles are still almost 100 million barrels above the 5-year average for this time of the year, and production keeps rising. But things are beginning to change in the U.S., too. Shale producers have idled 24 oil rigs over the past 6 weeks, indicating the drilling boom might have peaked. Harold Hamm, the billionaire shale pioneer who runs Continental Resources, said last week that a government projection of more than 1 million new barrels a day in U.S. production this year is flat wrong, because drillers are being more cautious about expanding. Hedge funds boosted their West Texas Intermediate net long position, the difference between bets on a price increase and wagers on a drop in -32% to 208,292 futures and options in the week ended September the 19th, U.S. Commodity Futures Trading Commission data show. Shorts fell by 15%, while longs rose about 9%. As for Brent, the net long position on the global benchmark increased by 8% to 464,980 contracts, according to data from ICE Futures Europe. It has more than doubled since the end of June. Meanwhile, the continuing fallout from Hurricane Harvey has hedge funds betting that fuel prices will rise. Although Texas refineries knocked offline by the storm are coming back, it could be weeks before crude processing capacity is restored. We've had massive draws on inventories of product, more than was expected, Toronto Dominion Bank's Milek said. Money managers raised their net long position on benchmark U.S. gasoline by almost 4% to 71,193, the highest level in more than 3 years. The net bullish position on diesel climbed 11% to the highest since early 2013. Whether the optimism over West Texas Intermediate will stick remains to be seen. After closing above $50/barrel for the first time since July last week, prices for the U.S. benchmark got a bit stuck. It wouldn't surprise me to see some longs come off, just taking some profits, Tariq Zaher, a New York-based commodity fund manager at Tide Capital Advisors LLC, said. That's been the trade. Buy at $45, sell at $50, and until you consistently break that 200-a-day moving average to the upside, until you're proven wrong with that, continue with that trade. To get faster updates and the latest news from the oil and gas industry, please subscribe to the YouTube new video channel and connect with us on Facebook, Twitter or LinkedIn.